I will say that Jay Powell will not be happy. I will say he's starting to get a little bit nervous.
I really think that China is at that stage now. I think China are about to have a lost 20 years.
NVIDIA earnings, 28th of August. Do we see the stock go higher the next day or lower? Welcome to the Market Edge, our monthly show where we talk through our trades and ideas, what's gone wrong and what hasn't.
Yep, we're here to give you our chart of the month, the most important chart for the next 28 days, and also give you an insight as to what we think the most important events that you have to pay attention to will be.
And why is it worth listening to us? Well, being British, we don't like to blow our own trumpets, but...
Rich became one of Credit Suisse's youngest ever directors at the age of 30, as their head of equities emerging markets. Prior to this, McDonald spent 3 years as a junior fund manager for one of Europe's top hedge funds during the financial crisis. David's been a big name in the retail trading industry for 10 years and worked in fintech while trading his own funds and running a research firm.
Right, David, so we're about to go through our trades and what a volatile month it's been. But first, let's take a look at our meme of the month. So, for those of you that can't see it, we've got the picture, the famous shooting competition from the Olympics where we had our competitor number one in his full outfit with all the technology and the vision glasses. And in stock market terms, that's the trader who has 4 monitors, 6 brokerage accounts, 15 stock forums, trades 40 to 50 times a day, and he's down 60% on the month.
And then number 2, we've got Jose Mourinho. He's been dollar cost averaging into Spider, the S&P 500 index, for the past 12 years. He has no idea what's happening in the markets because he hasn't checked his portfolio in a decade, but he's got absolutely no gear. He's come in his own reading glasses. He's not doing the silly backbending special technique, and he's also just got a turkey shirt on. I love it.
And did you enjoy the Olympics?
I didn't really watch any of it. I watched one bit of the weightlifting.
Too busy trading 60 times a day.
Wow. Maybe 70. But no, I didn't really watch that much of it, to be fair. Weightlifting was good, but you know, I think from this perspective, it's kind of a great encapsulation of simplicity versus complexity, and maybe what retail traders should do and shouldn't do. Completely depends on your perspective, of course.
That's it, and we'll run through what caused that volatility shortly. However, I would say in this second scenario, you know, doesn't even know what the carry trade and the events that happened there in mid-August. But if you look at the bounces that we've had since, NVIDIA's up 30% from its lows in 1 week. Bitcoin's up 25% from its lows in 1 week. It's just absolutely staggering. So why don't we go on to the reason why we've had such bounces and such horrific moves down in the first place?
Well, I think it was one of the biggest volatility blow-ups that we've ever had, but I think it's not really stuck around. So it's not been called that, you know, not like previous events, you know, when we had COVID, when we had Volmageddon back in 2018, financial crisis. These were all quite sticky volatility events, but the market's just really bounced back. It's really resumed its previous path nice and quickly. There's probably going to be sticky paths ahead, but right now it looks quite healthy.
And I think this takes us down to where we are, David. You, the eternal bull, and me, the eternal overly cautious bear. Of course, it hasn't worked, as we've seen with our Turkish shooter here. You know, he's the one that's had a fantastic performance, been dollar cost averaging into SPY. I'm the one that's probably missed out on a lot of that performance because I have been way too cautious for the past 3 years. Just waiting for the economy to slow and respond to the interest rate increases that we've had. For me, I think we're really getting to that point where this time lag of the large interest rate increases that we've seen are starting to come through. So we've had a Home Depot profit warning just in the last few days. We've had Nike, of course. You just see time after time, you've seen evidence of the consumer slowing. And, how does that fit into your bull thesis going forward?
Well, I think the most important thing about markets these days is the level of liquidity that we're constantly at. I think the amount that central banks have done over the last 10, 15 years has really contributed to a brand new baseline. And the expectations and psychology of the market is, even if we do start to get bad data, what's going to happen around the corner is QE, lower interest rates. They're going to be ultra responsive to asset price decreases. We saw it over COVID, and if, for example, the dollar starts to find shortages, which tends to precede most crises, then that tends to be when the Fed acts, or at least when other central banks act with dollar liquidity swap lines and things like that. There's a requirement these days for central banks almost to act really, really quickly. And I think that's so important in the psychology of the everyday investor these days.
And talking of the dollar, that takes us on very nicely to our trades of the month from last month. Now, it's going to be very hard to beat those because we have both nailed it. Let's be honest. Congratulations. You're long of yen.
Yep.
So, shorting US dollar yen was absolutely inspirational. That was...
I mean, I have to blow my own trumpet on this one, because this was insane. And the funny thing about trading sometimes, when I called that on the previous podcast, we're trading at 161, I think.
That's right.
Traded all the way down to maybe, was it below my target even? What was the low on dollar yen? Was it 143?
Yeah, 143, yeah.
So I called 145, I believe, which was a massive jump. And I think the key thing to realize in markets is that sometimes you don't need to get the actual reasoning correct. What you have to realize is the extent to which something has moved past normality, I guess. And dollar yen, had increased to such a level, nearly tickling up at 170 over a relatively short period of time, the last year or two, that it was always due a snapback. The most important thing is thinking of the market like an elastic band. That's always the analogy that I have in my head.
Nice.
And sometimes it doesn't matter what the asset is. Sometimes you just look at the data and say to yourself, is there sufficient reasoning for a snapback here? That tends to be where the home run trades come from.
Absolutely right. And also the home run on the way down, my trade of the month obviously being short NASDAQ.
NASDAQ, great stuff.
Again, not quite for the reason that panned out, but we woke up on that Monday morning and just had that shock factor of the down 12% on the Japanese markets with the big move in the yen. And of course, the NASDAQ was dragged down with that. However, looking forward now, okay, because that gave us all the opportunity, even the likes of gold dropped on the back of it. And I found myself, the first thing I wanted to do was raise cash by selling positions that hadn't sold off. I wanted to raise cash to then invest into the market that, NVIDIA down 25%. I definitely wanted to get involved in some of that. Bitcoin down at 50,000. I thought that was one of the best opportunities we've seen in Bitcoin for a while. So I sold my British American tobacco shares. I sold my gold. I sold my US treasuries. So you can also see that things that have absolutely nothing to do with Japan or, people aren't leveraged long of British American tobacco, you can see why they also sell off to come into the asset that's cratered.
I think both of our trades come down to the fact that it's kind of like, do you want to be right or do you want to make money? And at the end of the day, that is exactly the mindset that traders need. You can see all of this macro analysis online and all of this stuff. No one cares about your reasoning if you're not able to monetize your actual position. And at the end of the day, that is all that matters as a trader.
And that's great for those of you who are listening, who are maybe new to trading or relatively inexperienced at trading. Managing your risk is the ultimate number one that I think both of us, the advice we give is to have the discipline And in shocks like in the last few weeks that we've seen with the yen carry trade and the volatility, then managing that risk is everything, isn't it?
Absolutely. Have the risk managed so you can stay in the market to actually get those home run trades. I think that is absolutely paramount. You probably know it from your experience that most of the P&L, or most of my P&L anyway, comes from a handful of trades a year. It doesn't come from trading daily because that's ridiculous. Yep. It comes from a few really, really core positions. And being able to be alive to manage and to actually action those core positions is so vital. Absolutely the most important thing.
That's right. Okay, so looking forward, what catalysts do we have in the next month? Now, I think your phrase, being the bull, would be buy your calls, sell your puts. Jay Powell's got us, so fill your boots.
I think after today's CPI, it was relatively in line, wasn't it? We're basically priced for a 25 basis point cut, and it was very interesting looking at interest rate futures, at how they'd really, really overpriced the cut about a week ago, I'd say.
An emergency cut even.
Well, yeah, exactly. It was just ridiculous. And I called it out. I said, this is totally mispriced. There's absolutely no reason for the market. We're talking about secured overnight financing here. There's absolutely no reason for that to have increased to the level it had. And it's sold off a little bit now. I think it's trading about 95-ish, between 95 and 95.25. And so I think, that is really, really key, that we've seen a really, really swift move in interest rate futures and then back down. So I think from that perspective, looking forward, the CPI has basically nailed on the 25 basis points cut. And Jerome Powell is probably laughing because we're seeing the volatility just smooth out, because the market is very assured actually on what the Fed is going to do. I think the market's been very sure on what the Fed's going to do for a good while now. And if we want to talk about a story, we can talk about the Jerome Powell story, because I think he's been fantastic in terms of guiding the market as to what the Fed is going to do.
And of course, we do have Jackson Hole coming up in the near future, 22nd to the 24th of August. And I think that is going to be key, because that's where we're going to see the transition that Powell makes from having or requiring this confidence that inflation is going to return to its target. I think that confidence level will have been reached now. Or he's going to say that the balance of risks now outweigh the confidence that needs to see inflation return to target. The balance of risk now shifts towards watching unemployment, because of course in the last jobs report we had unemployment reach the high level of 4.3%, which is way above their prediction for where it would end 2024 at. So I'll take the other side of your bull call. I will say that Jay Powell will not be happy. I will say he's starting to get a little bit nervous. He's only human after all, right? So he has to come out and he has to act confident. I think there will be a bit of him that is worried about the momentum in the jobs market, and it is stalling. The economy is stalling. So I worry that if we get down to 4.5% by the end of the year, that's still actually breaking the economy. And the momentum now is in that unemployment rate. I think that's heading towards 5%. That's where you're really going to start to get bad data come through on bank loans, on credit card defaults. And we're going to start to see consumer spending really not just slow, it's going to start being negative. What we started to see now is that unit numbers are negative. So people aren't buying as much, but because retailers have put prices up so much, the actual revenues are still positive. I think we actually see retail sales drop off into negative. And then that's when margins are hit. And margins getting hit means the S&P 500 comes down. So we'll put our flags in the camp there, bull versus bear. But I absolutely take your point on liquidity, because that has been correct all along. Right, so moving on to our chart of the month then. David, what have you brought in for us today?
Chinese government 30-year bond, purely because their yields are at literally decade lows. Well, longer than that, actually. This chart doesn't even go far enough back. This chart is from Bank of America, Bank of America's flow show. And I really think it's identifying the state that China is in currently. There's not actually been that much chatter about Chinese economics recently, mainly because people are concerned that the data isn't actually real. Of course, that's always a concern. But I think because there's been no specific blow-ups, we've had the property issues, which have been contained politically, very much politically, not so much economically. From what I understand, there are considerable issues going on in China right now internally.
Right.
There's been, 15,000 millionaires that have left. I know of FX desks that have been set up purely to get money out of China, legally, of course. But yes, very much set up to facilitate getting yuan into dollars and out, whether it's to the UK, the US, Canada, wherever.
Wow.
This is happening. And they're making a lot of money, these FX desks as well. And so I think the story of China is really, really tricky. I wrote a piece a couple of years ago before actually everyone else on the Chinese property market, and specifically to do with Evergrande.
Yeah, I remember.
And this was based on the Chinese working population as part of the thesis actually having started to decrease. So there's actually a turning point that is very, very similar to Japan in 1989 that is going on in China right now with regards to debt, with regards to the property market. Japan had a very, very prosperous in sort of air quotes there, a prosperous property market before the lost decade of the 90s.
Yeah.
And then, of course, it had the currency crisis in 1998, which is when they kicked off quantitative easing, 10 years or so before everybody else. I really think that China is at that stage now. I think China are about to have a lost maybe 20 years, very similar to Japan. Kicking off from now, we're hearing a lot about the technological innovation coming out of China with driving cars, self-driving cars, electric vehicles, all of this. But this is all very similar to Japan. Toyota, obviously the biggest car manufacturer in the world. And funnily enough, they were actually the first electric car manufacturer that went sort of mass market with the Prius. And there's a lot of very, very similar sort of case studies here with regards to debt to GDP, with regards to demographics, aging demographics. And do you know what the biggest risk to China is right now?
Is it population?
It's population, but from the perspective that China now has a demographic where the young, who have traditionally been quite wealthy, are now having parents that are moving into retirement age, but both are living for a very long time. So all of that wealth that these younger people have had is now going to have to be transferred to looking after two sets of old age parents. So there's going to be less consumer spending going forward,
Right.
in my view. And this is very, very similar to what happened in Japan. So there's kind of a benefit to having an older population, but when your property market is so decimated and so unequal as well, that creates the massive issue, because rather than having a lot of wealth in more liquid assets, you've got it all stuck in a property market, which when credit dries up, that wealth just dissipates straight away.
There's one stock that I really like, and that is Prudential. Okay, so London listed company, but operations all around the world. So it's on 0.5 times embedded value, and just look at that channel that we've seen. It dropped from £12 to £6 over the past 2 years. It's just incredible thinking, what global markets have been doing. And that is the performance of the Pru. So numbers on the 28th of August, the same day as NVIDIA. So, be very busy. These will be first thing in the morning, NVIDIA last thing at night. It's going to be a long day, I think, of trading. But I just started picking up some of these this morning. I think it's bounced off that bottom channel. And if we now get a break up and it breaks through the top channel, through the £7, then I think we could start to see some real movement higher. And what could the catalyst be? Well, let's say the money has certainly come out of China-related stocks already. And you can see the performance here. The valuation gives it some backing, but also there's that outside chance of M&A activity. Would somebody like Buffett want to take a stake, right? He loves insurance. This is a bite-size kind of level for him to take a stake. Or even in M&A, would somebody like an HSBC come in, right? So it's got a market cap of £17 billion. And that would be a really interesting addition to their business. So my trade idea of the month is the Pru.
Well, mine is very different to yours. It's probably, I would say it's a lot shorter term. So we're probably looking at the next week or two, whereas I think yours, 28th of August is, well, actually, no, it's about 2 weeks away now. I've lost time.
Summer does that.
But I think over the next week or so, I think Intel has sold off way too much.
Ooh, yeah.
I think in terms of, if we just think about Intel as a company, they're still a massive chip maker. They've lost, 30% of their value in the last 2 weeks.
Wow.
Insane. There's no reason for it to have lost 30% of their value in the last 2 weeks.
What level have they dropped to now?
They've dropped to $20.50, I believe.
Wow.
And they fell off from, I think it was about $30.
Yeah.
So if we look at, a return to that level, if we're looking at, if the S&P continues to tick higher, for example, rising tides lift all boats.
Mm-hmm.
I don't see any reason why it couldn't start touching $28, $29, which is a 50% increase. I know it's quite significant, but that is the levels that we can look at. And
yeah.
I think as well, if you consider that Intel have looked to cut a hell of a lot of jobs, that should be a support for a share price. Most people would think that's a bad thing. A massive cost cut like that, no, that's fantastic because it makes net income look way, way better.
And do you know what? You've just inspired another idea to pop into my mind. Because when you're talking about movement in the jobs market, when you're talking about irrational moves, what about Starbucks stealing away the CEO of Chipotle? Do you know the market cap transition from out of Chipotle and into Starbucks yesterday was over $20 billion. One CEO is worth $20 billion.
That is a fantastic stat, to be fair. I think, it's very, very interesting. Do you know whose largest position is Chipotle?
I actually don't know.
Bill Ackman.
Oh, really?
That's Pershing's largest position is Chipotle Grill. It doesn't make sense necessarily in my head, as I said. I disregard anything irrational when it doesn't necessarily make sense. I don't care about it. They've had a massive expansion globally over the last, say, 7-8 years specifically. But to me, it's like a Wingstop story. The fast food industry outside of McDonald's doesn't make sense because it's not got the same property enterprise as McDonald's, if that makes sense. McDonald's makes sense to me as a stock. I completely get it. The others not necessarily, purely because of the McDonald's legacy more than anything.
Certainly.
And I think it's a very, very interesting trade that you mentioned there with regards to Starbucks, because I thought Starbucks was a good buy back in, when did I think it was a good buy? I think it was January or February. Mm-hmm. They got smashed by the earnings, didn't they?
Yeah.
And also coffee increased quite heavily. So I sort of had a hedge trade that didn't make any money. I was long coffee futures and also long Starbucks.
Nice.
So it was like, I was expecting Starbucks actually to increase in price with price insensitive buyers. But no, that wasn't the case really.
And that's what's really interesting with the consumer as a whole is they are becoming price sensitive and they are stepping away from those price increases. But that's not the trade idea.
Ah, right. What's the trade idea,
That's the
Rich?
setup.
Right.
So we saw 20 billion get added to the market cap of Starbucks yesterday. who's going to be next? Who's going to be the next one who has had an awful performance in the past 12 months, needs to get rid of their CEO, and it's a very well-loved international brand, listed in the US, one of the previous darlings of the US stock exchange, and will go up 20% if they manage to hire the right CEO. I'm talking about the swoosh. Do we have any guesses?
Nike.
Yes, Nike indeed.
Do you know what? I was thinking about Nike earlier today because I was thinking about my next pair of trainers. And
Yeah,
Nike
you do need a pair looking at today's fashion.
I shall bite my tongue, Rich. And Nike didn't enter into my head
No.
at all for my next purchase. They really, really didn't, which is strange because the pair of trainers that I had on were Nike.
Yeah.
It's a really, really strange brand transition they've had. And I said on LinkedIn that they've kind of lost the culture, which I think they have really, really badly. And I think you're absolutely right. A change of CEO would send the share price up purely on an expectations basis of almost like release of the badness, drawing a line under it.
It's in a death spiral. I was in Paris at the weekend to watch the last weekend of the Olympics. And on a Sunday, we decided to go for a hike. And there was 7 of us on the hike, and 5 of us were wearing New Balance, and 2 others were wearing hiking shoes. But there wasn't a pair of Nikes to be seen in the house at all. And that is just incredible transition. 2 years ago, I would have gone and did, have a wardrobe full of Nikes. And now slowly I'm going Adidas, New Balance, or some funky Zara Zone because they're so cheap.
Yeah, I think it's a very, very strange transition because I don't even see the younger people at my gym, for example, wearing Nike.
Right. So before we wrap things up, I've got one last question for you. NVIDIA earnings, 28th of August. Do we see the stock go higher the next day or lower?
It's a very difficult question, actually, because I feel like even if the earnings were to go, no, I'm joking, it's going to go higher.
It's going to be so interesting because we already know that Blackwell's delayed. We know that they've got a full demand, book of demand there. So what does he come out with? I've seen earnings previews for 6 to 8 cents for EPS for the quarter. $4.95 for the year. $4.95 for the year means that at $110, they're on 23 times earnings.
It's great.
That's scary.
It's fantastic.
That stock can definitely go higher. So there you go. There's something we agree on.
Versus sector PE as well.
And surely we'll drag Intel up.
Which is maybe 4 or 5 times undervalued versus sector PE.
Yeah.
Amazing undervaluation. I think it's going to have another blockbuster. And I've said as well, we are in a stage of disbelief, or at least we're entering a stage of disbelief. I feel like people are very, very connected with the pivot into cuts. Mm-hmm. And they think there's going to be turmoil, as you do. And I just see a stock market disbelief rally into the end of the year.
Excellent. Well, everybody, thank you so much for joining us for the Market Edge.
Thank you.
And we look forward to seeing you next month.